Good evening everybody and welcome to F8. And it is Audit and Assurance Revision Class number 4 for the March 2017 sitting. So this is it guys, final class of term. In our first 3 classes I've made a point of making sure we have practiced heavily the big 3 core mark getting areas for the long questions. So we have done plenty of risk and response, we've done internal controls, we've done substantive procedures. Those are the big 3. I think I'm right in saying in December's exam, those 3 accounted for something like 55 of the 70 long question marks. So they're absolutely critical. And they're not things that require huge amounts of knowledge, they are things that require technique, practice. Because the way you write the answers is the way you demonstrate whether you understand what's going on or not, the way you write them. So you've got to come up with the points in the first place, and sometimes that's a battle, but then it's how you write them down that makes so much difference. So for our final evening, we've got a few bits and pieces to go through, a few bits of knowledge and understanding to make sure you're okay with those. We've got some internal audits and corporate governance to go through, a bit of audit reports. So we've got some more questions to look at to help cover the bases with those. And we will be interspersing, as always, the questions with some more technical revision. Or technical revision even, if my voice can be bothered to hold up. So we're going to start tonight with a little bit of technical revision. And just before I get into that, talking of technical revision, oh. Maybe you are already aware of this, or maybe you are not. PQ magazine, PQ for Part Qualified, is a magazine aimed at accounting students who are currently studying, be it degree courses or they're rather more tailored towards people doing professional qualifications like yourselves. And if you go to that magazine's website and you click on the latest issue of the magazine and open it up, you'll find a couple of things of interest. You will find tips of 1 or 2 colleges, including Lsbf's tips, which of course include F8. But there is also in that issue an article that looks at new audit reports. So just a reminder, the audit reports, which have been pretty much the same for a very long time, have just gone through a period of change, and those changes have only hit the ACCA's exam syllabuses from September last year, so they're relatively new. Some of the things in there require a bit of thought, a bit of explanation, a bit of understanding, a bit of practice before exam day in 7 days' time. And PQ asked me to write an article on it, and that article is in there this month. It won't tell you anything that I've not told you in the classroom, of course, but it will explain it in a bit more detail. There's a nice example in there, so hopefully that will help you out. Excuse me. Right, we begin with a little bit of technical revision. And we start with something from Audit Standard 210. 210 is an audit standard from before you have even said yes to doing the audit. It's things to consider as part of the terms of your audit agreement with your client. So sort of pre-appointment stuff. And one of the things in there is a technical term called the preconditions for an audit. Well, pre means before. Conditions are things that need to be in place. So preconditions for an audit are the things that need to be in place before the auditor can accept. And specifically, they are the things that need to be in place that allow you to be able to carry out an audit process. So if these conditions aren't there, you wouldn't be able to do a proper audit. There are 3 preconditions. So before you say yes, Board of Directors, I will come and audit your accounts, management must confirm that they have fulfilled their duties regarding the following 3 things. The first one will sound a little bit odd perhaps. An appropriate financial reporting framework has been used. What does that mean? It means that when you prepare accounts, you have to do it within a particular set of rules. Now, we are largely used to preparing a set of accounts that follow company law in the UK, and of course, hopefully, that follow the accounting standards IFRS, the International Accounting Standards. But you might be auditing a client that shouldn't be following IFRS. Now, for this course, that's not going to happen. But when we do audits, we must make sure that the company is doing the accounting standards they are meant to be doing. Number 2, an internal control system is in place to prevent and detect errors in the financial statements. We would never be able to do enough substantive testing if there were no controls at all. We've got to get some reliance from controls, and management must also confirm that all books, records, information, etc. will be made available to us. I must apologise. Unfortunately, all the lifts in our building have gone down within the last 20 minutes or so. I had to run up the stairs to get here on time, and this seems to have had a bit of an impact on my ability to breathe. So there you go, financial reporting framework, controls, books and records, and that is preconditions for an audit. Right, good stuff. Time, I think, for our first question of the evening. And the first one we're going to look at tonight is December 2014, and it's question number 6. So there we have December 14 paper, just in case you think I am making this up. Some lovely MCQs you might want to practice at some point. And here is question number 6. As always, we ignore the story for now, and let's go and see what we can find from the requirements. But first, I'm afraid I'm going to have to clear my throat. Right, part A. For 5 marks. Explain the factors Puffin and Co. should consider. So things to think about when placing reliance on the work of the independent valuer. Now, obviously, I've not read the story yet. I've not read the story yet, so I do not know on what basis they are saying this value is independent. And I also don't know what they're valuing. So I do need to read the story at some point. But the issues relating to placing reliance on anybody tend to be the same thing. Because you are only going to place reliance on somebody. In other words, instead of you doing some work, they're going to do it and you're going to rely on what they did. You're only going to do that if they're reliable. And when I say they are reliable, I mean the valuer, the expert, and the work that they've done. We're looking for 5 marks worth of answers to 5 separate points. If I'm going to rely on any sort of expert, I need to know that they are an expert who can be relied on. Which means I will need to check and see if they have any relevant professional qualifications. I need to assess what experience they have got in valuing this sort of thing in the past. And I know it says they're independent, but I need to assess if they are independent. So there's a pass immediately. Those 3 things explained in proper sentences will get you 3 out of 5. But it's not the only things that tell me if this person is reliable. Because another thing to decide if you're going to rely on somebody is, have you successfully relied upon them in the past? I mean, maybe you've audited this client before and they've had these valuations done and you've checked this expert's work before. Or maybe this expert has turned up at another audit client doing some valuations. So there's my thoughts in terms of, is this a reliable person? Once I've decided that I think they look reliable as a person, I do have to then check the work they've done. What would I check about it? If there's any calculations in what they've done, re-perform them. If they've made any assumptions when doing the work, do those assumptions look fair? And if they have based If they have based their valuations on any external facts, I should verify those facts. So, for example, the value of some things would be affected by interest rates. And if they've said, based on the current interest rate of whatever that is, I ought to go and check that that is the current interest rate. Should be easy enough to do. Well, that to me seems to be about 7 separate points. I need 5. And the only issue now is when I read the question, will it be so weird that what I've written up there doesn't work? Well, it's never been weird before, so I'd be surprised. But when we read the story, we'll just make sure that what I've gone for seems to be okay. And then we get to the big juicy bit in the middle. 10 marks split between two separate things. And here comes the practical stuff. We need some substantive procedures. Whenever we've done substantive procedures, I have told you to do the same things. I have said to you that substantive procedures are about testing assertions by doing tests, AEIOU, to collect evidence, DAR 3. Maybe that sort of approach will help. But I've also told you that if you get any sort of detailed story, just ask yourself how you would check the facts, the dates, the events, the amounts that are in those stories. There are two requirements, it seems, in this question. The first one is worth 6 marks, and we need substantive procedures to obtain sufficient appropriate audit evidence in relation to the revaluation of land and buildings and a recently purchased warehouse. So just to repeat that, we need to get audit evidence regarding revaluation of land and buildings and audit evidence relating to a recently purchased warehouse. Obviously, the story is going to give me a bit of help. But even before I look at the story, if they have revalued stuff, AEIOU, I inspect, because I can inspect the valuation report, say it, say why. Why am I doing this? To verify the valuations that are now in the financial statements match the valuer's report. I also happen to know that when you revalue assets, any surplus should not go into profit this year. It should go to a separate revaluation reserve. So I will need to inspect the T accounts of the company to verify, always say why, that the surplus has gone to a separate reval reserve, not to the profit or loss. And I also know that if you revalue an asset upwards, the depreciation charge this year is going to go up as well, because you've got a bigger number to spread over the useful economic life. So I would also want to recalculate the depreciation charge on revalued assets to verify it has gone up than last year. In other words, they've used the new higher revalued amounts. And I would do that on any revaluation at any company, so it's right. I don't care what the story says. That will always be right. Apparently they've also bought a new warehouse. Well, I ought to make sure that it exists. They've got the right number in the accounts, valuation. that it belongs, rights and obligations, to the company. I'll start with that one, in fact. I will inspect title deeds and land registry information to verify it belongs to my client. I will inspect the purchase agreement and bank statements and cash book to verify the price paid, and then I will match this to the cost figure in the asset register. I will physically inspect the warehouse to verify it exists. I only need 6 tests, that is 6, so I'm going to stop writing now. It's a new asset, it would need a depreciation policy, so compare the policy with the policy used for any other warehouses and similar buildings in the past, or at similar companies who have similar warehouses, to make sure that the useful economic life looks realistic compared with other examples. I would then recalculate the depreciation on this warehouse for the first year, making sure it has been prorated based on when the purchase date was. Still haven't read the story, and I think I can get full marks on A and full marks on B. Well, B1, because I haven't yet done B2. I'll leave a bit of space just in case when I read the story I get some other interesting ideas. In fact, let's come down to the top of a new page. It says I've also got to do substantive procedures on the valuation of work in progress. Notice we have an assertion. I'm not going to check the work in progress exists or belongs to the company, purely its valuation. I've got to come up with 4 tests on that, and that looks quite difficult. So what I'm going to do at that point is go read the story. See if I can get any help. Jackdaw Motor Cars manufactures a range of motor cars. Who'd have thought with a name like Jackdaw Motor Cars? And its year end is the 31st of January 2015. You are the audit supervisor of Puffin & Co. and are currently preparing the audit programs, that's the list of tests you're going to do, for the year end audit of Jackdaw. You've had a meeting with your audit manager, he's notified you of a number of issues. Land and buildings. Jackdaw have a policy of revaluing land and buildings. This is undertaken on a rolling basis over a 5-year period. Well, I suppose another test I might want to do on their revalued buildings is not necessarily on the ones that they've revalued this year, but if they're only revaluing each building over a 5-year period, some of the valuations might be a little out of date. So I might want to go and get my own expert to value some of the buildings that haven't been revalued for a few years and make sure the valuation in the books is not too far off, because you've got to keep your valuations up to date. During the year, Jackdaw requested an external valuer to revalue a number of properties, so there's the independent valuer, including a warehouse purchased in May 2014. Not quite sure why they need to revalue it so soon after buying it, but there you go. Depreciation is charged on a pro rata basis. Well, I've already worked that into the audit tests I've written down, so nothing really telling me what I've done is wrong, so I'm quite happy with my answer. Work in progress. Now this one is a very good example of where reading the story and testing everything it tells you is very helpful. 4 tests on the valuation of work in progress sounds a bit complicated, but listen to what the story says. Jackdaw undertakes continuous production of cars, 24 hours a day, 7 days a week. Inventory count is to be undertaken at the year end. Puffin will attend. You are responsible for the audit of work in progress. Be part of the team attending the count as well as the final audit. Now maybe that's a clue, suggesting there's work we can do at the stocktake and additional valuation work we might do at the final audit. Worth thinking about. But it then does something very helpful. It says, work in progress constitutes the partly assembled cars at the year end, and this balance is likely to be material. Okay. Jackdaw values work in progress according to percentage of completion, and standard costs are then applied to these percentages. So what exactly are we trying to test? They will look at each car or batch of cars and say it's this percentage complete. They are then multiplying that by the full standard cost of a finished car. And they're getting a value. They are going to do that for all of the cars and then add it up. I've got to check that valuation. Well, it seems to me that there are 3 things already I can check. Have they got the completion or the completeness right? What about these standard costs? And if they're doing a calculation, I ought to check it. Let's go for the simple ones first. I would recalculate percentage complete multiplied by standard cost for a sample of cars to verify calcs are correct. Now I can't believe I will get both of these marks, but I'm going to go for 2 of them in the hope of getting one of them. I've added a cross. I ought to now check that the total of all the valuations adds up as well. So recast or retotal the WIP schedule to verify, always say why, it adds up correctly. Next bit. Well, I don't think I'm going to be very good at knowing that a car is 74.26% complete, because I don't know enough about cars. I think I need to put an expert on the stocktake attendance team and I would get that person to physically inspect work in progress cars at year end to assess, whoops, missed out a word, if level of completeness looks accurate. They've then multiplied that percentage by the standard cost of each car. How do you know they've done that right? For a sample of cars, agree the standard cost back to the standard cost card for those vehicles. And that is 4 tests. They are not the only 4 tests I would do. I'm checking the valuation of work in progress. I'm thinking AEIOU types of test. And I can think of another analytical one. Because if they make cars 24 hours a day, 7 days a week, surely it is the case that they are likely to have pretty much the same amount of cars in production at any point in time. I think, therefore, I would compare the year-end WIP valuation with the WIP held at month ends during the year to assess if the year-end figures look realistic. A bit of analytical. Well, I've got enough, so at that point I should stop. That's quite a tricky one, I think. Part 1's not quite so bad, but that is tricky. But do notice how the scenario helped. It tells you where they've got this value from. It's x times y equals z. We'll make sure x times y does equal z. Make sure all the z's add up to a total at the bottom. And then check x and check y. Part C. During your audit, your team has identified an error in the valuation of work in progress. You see, you did some tests, you found a mistake, as a number of the assumptions contain out-of-date information. Interesting, because I didn't write as a test on work in progress just now, check the assumptions are current. Does that therefore mean if I go back to B part 2 and write review the assumptions used in valuing work in progress to make sure they're up to date, I'll get a mark? Yes. In other words, in part C, your lovely examiner is giving you an audit test you could put in B part 2. Isn't she lovely? But let's carry on with part C. So there's an error in valuation as a number of the assumptions contain out-of-date information. The directors of Jackdaw have indicated that they do not wish to amend the financial statements. So the accounts are wrong, the directors don't want to change them. For 5 marks, suggesting 5 things to say, explain the steps Puffin should now take and the impact on the audit report in relation to the director's refusal to amend the financial statements. The accounts are wrong. The directors do not wish to change them. When I get down to thinking about audit reports, I need to decide, is this material? And if it is material, could it be pervasive? So the first step I think I need to do is to find out if it's material, because there are no figures given. Why am I doing that? Because if, for example, it is greater than 5% PBT, it is likely to impact on how the shareholders view the financial statements. But another step that auditors tend to take on a regular basis on this course is anything interesting happens during the audit, you discuss it with the Audit Committee. So you tell the Audit Committee of the mistake, and ask them whether or not it will be corrected. And if not, why not? I would also be very keen to suggest that if we know the accounts are wrong but the directors don't want to change it, that is potentially a reason to resign, because we don't want clients where directors are happy that wrong information gets presented to the shareholders. So consider resignation because client seems willing to send inaccurate financial statements to the shareholders, which would seem to be a lack of integrity. So there are some thoughts on steps. What about the impact on the audit report if they don't change it? In one of our previous classes, I revised audit reports and the various outcomes we can have. And now we're going to put that into play. Do I need to modify the opinion? Well, we modify the opinion for two reasons: a lack of evidence or the accounts are materially wrong. We don't know materiality yet, but the accounts are wrong. So I would say, assuming the mistake is material, what would you do? You would have a qualified opinion except for due to a failure to value some of the inventory, the work in progress, in line with accounting standard number 2. And useful thing to remember that should get you another mark is whenever you modify the opinion, you have the explanation of the modification underneath in the basis for opinion. And there you have it. Another exam question safely ticked off our list. Hooray! Moving onwards. Time for another bit of technical revision, I think. And the next thing I want to mention is quality control. This is a relatively new area for the F8 syllabus, and as with any relatively new area, that increases the chance that the examiner is likely to set it. If I want my audit work done at a high level of quality, there are two things I want to consider. When I do the actual work, I want quality in the work processes. But before I've even got any audit clients, I would like to make sure my firm is set up such that anything it does should be quality overall. That means having a quality control partner. It involves having documented processes for all aspects of the audit. Training of staff to make sure they know what those processes are. It's helpful if all the partners in the firm constantly refer to the need for quality. Then the message gets over very quickly. Anything that's done which is not good enough should be done again, and those who didn't do it well should be disciplined in some form, and that will soon get the message across. And let's have one more idea. Cold file reviews. So these are the reviews where every so often a team of people from the firm go and open up audit files that have been completed in the past and go and make sure that the firm's procedures are being followed. And then there is the quality control on each assignment that we do. And if you want every bit of work you do to be good quality, you should plan it, document it in full, and it should be directed, supervised, and reviewed. Generally by senior staff, and especially focusing on the work done by the more junior staff. And if we're going to have cold reviews over here, I can't help feeling we might want to have some hot reviews over here. What's a hot review? A hot review is where a second independent person, typically a partner, checks the contents of the audit file before the audit report is signed. Why would you do that? You want to check before the audit report is signed because you are genuinely concerned that you might be about to get this audit wrong. Why are you concerned? Well, either you know there might be an issue with this client, maybe they're new, or maybe there are ethical threats, they're very complicated, or they're a high-profile client where it would be very embarrassing to get it wrong. Maybe they're a listed company, for example. So there are some examples of where quality can be built into audit firms overall and audit work. Time, I think, for us to have a go at another question. Which one shall we do? I think, looking at the timing at the moment, that probably this one would fit rather nicely. June 15, question number 3. So there we have the June 15 paper. Some lovely MCQs. And here is question 3. There are 10 marks available. Apparently the total marks will be split equally between each of the 2 issues. So that's worth 5 marks and that's worth 5 marks. And what do we have to do with each of these issues? For each of the 2 issues, we need to discuss the issue, an assessment of whether it's material, recommend just one procedure, so that's AEIOU, data 3, or test facts in story, and with only 1 mark available, 1 test, surely we can come up with something. And describe the impact on the audit report again if the issue remains unresolved. What is the issue? How material? 1 test. Impact on audit report. 4 separate things for 5 marks. So generally you're getting 1 mark per thing here. Let's read it from the top. You are the audit manager of Chestnut and are reviewing the key issues identified in the files of 2 audit clients. Palm Industries. Palm's year end was the 31st of March 2015. Remember, this is the June exam. So if the year ends 31st of March, that was 2 months and 4 days ago. The draft financial statements show revenue 28.2, receivables 5.6, profit before tax of 4.8. I'm assuming that is there to aid us with materiality. The fieldwork stage for this audit has been completed. So the audit staff have gone out to the client, into the field in other words, done what they're going to do, and they've come back to the office. A customer of Palm owed an amount of $350 at the year end. Testing of receivables in April, don't forget it's currently June, highlighted that no amounts had been paid to Palm from this customer as they were disputing the quality of certain goods received from Palm. The Finance Director is confident the issue will be resolved and no allowance for receivables, in other words provision for doubtful debts, was made with regards to this balance. So we've got to say what the issue is. How material, 1 test, impact on audit report. Well, we only need to do 1 calculation. And if this receivable is at risk and receivables are assets, I suppose we could divide it by the receivables figure of 5.6 million. But the one that always feels safer is profit. And if we're going to say that this is a bad or doubtful debt, then profit will go down by 350 grand. So I reckon the first thing I would like to say for my 5 marks is that 350k divided by 4.8 million is 7.3% PBT, which is material. First mark. What is the issue? Well, the issue is a pretty fundamental accounting basic, which is assets cannot be held at any higher than their recoverable amount. If you don't expect to recover even, some or all of this balance, then whatever you don't expect to recover should not stay in the asset. It should either be provided against or written off. In other words, at present, receivables are currently overstated and expenses appear to be understated. But we don't know for sure because we still need to do one more procedure. What has happened in my story? Year end, 31st of March. During April, while the staff were at the client, they have checked and found that no money has been received. There's also a dispute going on. But the last thing I've heard is work that was done in April and now it's June. Well, wouldn't things have moved on since then? So the procedure, I would say, is inspect correspondence with the customer in April and May 2016. 15, to see if dispute is near resolution. In fact, maybe it's already been resolved. Maybe the money's even getting close to being paid. I do not know. But that's what I'd be doing. Impact on audit report. Assuming that we think this needs to be written off or written down, the accounts have only one mistake. But it is material. So what do we want in the audit report? Yes, as always it seems, a qualified opinion. Except for, and whenever you change the opinion paragraph, don't forget that an explanation of the error should go in the basis for opinion section. So there's my answer for the first one. Breaking down the requirements into the little bits and pieces they want me to do. Easiest mark, materiality. Procedure maybe not quite so simple, but the audit report doesn't seem too complicated. And that's the first of the stories out of the way. Now clearly that leaves us with a second story to do. I seem to be having, ability talking is what I seem to be having. I seem to be having a little bit of a throat problem. So I'm going to take the break slightly earlier than I otherwise would. And I will go and have some speech lessons as I seem to be struggling to talk. I will go get some water. And I think what we might do tonight, as it's the final class and I'm not sure how well my throat is going to hold up, instead of taking one 10-minute break or so in the middle, let's have 5 or 6 minutes now, and then we'll have another 5 or 6 minutes after another hour or so, and then a big final push. So we'll see you in a few minutes' time. Okay, back we go again then. A little reminder of what we're up to. We're looking at June 2015, question number 3. 2 stories, and for each of them we need to say what the issue is, assess materiality. We have also got to come up with 1 audit procedure, and the reason it's only 1 is because it seems like other procedures have already been taking place, so we're not starting from a blank sheet of paper, it's 1 additional procedure, and then talking about the implications for the audit report. 4 separate things to do for 5 marks. So let's go look at what the second story says. Ash Trading. Ash is a new client of Chestnut. Its year end was the 31st of January 2015. Remember, this is the June 15 paper, so February, March, April, May, 4 months have passed. And the firm was only appointed auditors in February 15, so after the year end, as the previous auditors were suddenly unable to undertake the audit. The fieldwork stage for this audit is currently ongoing, so your staff are still at the client. The inventory count at Ash's warehouse was undertaken on the 31st of January and was overseen by the company's internal audit department. Pretty normal. Neither Chestnut nor the previous auditors attended the count. Which means the previous auditors and our firm do not have any evidence of how much inventory was there at the year end. Detailed inventory records were maintained. Good. But it was not possible to undertake another full inventory count subsequent to the year end. Draft financial statements show a profit before tax of 2.4, revenue of 10.1 and inventory of 510. What is the issue? Remember, we're looking for 5 points in total. The issue here is I don't know if inventory is wrong. This is not a misstatement, this is a potential misstatement, because the issue is a lack of evidence. Because normally we would expect the external auditor to attend a client stocktake to assess the quantities in the records appear accurate, inventory that we can see appears to be in good condition because that affects valuation, and to test controls over how well the client's count is done. So we observe the counting, that tells us how much we can rely on the client's own figures, and then we'll do our own substantive testing to back that up. We have a lack of evidence. Question is, material, pervasive or not material at all? Well, it only seems to affect one number, which is inventory, so it's unlikely to be considered pervasive. Is it material? Well, it was 510,000. Inventory affects profit, which was 2.4 million for this client. Inventory is 510k over 2.4 million, which equals 510. 12 21.3% PBT, which is material. So I've highlighted the issue, I've done materiality, and now the tricky bit. How do I find out how much inventory they had and what sort of condition it was in and how well the stock taking went when it was 4 months and 4 days ago? Because I can't go back in time. Thing is, the story has a clue. Because somebody was at that stock take. Somebody we, the external auditor, might perhaps be willing to place reliance on. And that was the internal auditors. So I think the procedure I would carry out is I would assess the qualifications, experience, and independence of the client's internal auditors, and if they seem reliable, obtain their stocktake records and attempt to rely on those. Now, this is not the only possible solution in this situation. Given that our staff are still at the client, what we could do is get hold of the stock records today, ask our staff to pick some fairly large samples and verify them to make sure the records today are accurate. And we could then try to add back everything that has been sold since the year end, subtract everything that's been purchased since the year end, and that should get us back to what the year end figure would have been. But that is 4 months of sales and purchases. That is a lot of adjustment. And you are assuming that those 4 months of sales and 4 months of purchase figures that you're adding and subtracting are correct figures, which they might not be. Personally, I would go for that one. Whether it's enough, I do not know. In fact, I suspect it's probably not enough, but we'll have a go. Assuming it isn't enough, we then get to the audit report. And since we have got a material lack of evidence, this would suggest it's going to be the same as the first one. A qualified opinion. Except for the potential misstatements. To inventory. And as with the first one, we need to explain, not the mistake. We don't know if there's a mistake. We need to explain the lack of evidence in the basis for opinion section, which goes underneath the opinion. Notice one bit of technique in there. We have got 5 marks to earn for each of these 2 stories, but only 4 things we're required to do: issue, materiality, a procedure, and impact on audit report. Which means one of those 4 things needs to earn us 2 marks. If there's only one procedure, it'll only be 1 mark. You'll only get 1 mark for materiality. So it's either that the issue is complicated enough that we can make it 2 marks, and I don't think you can. In which case, where do you get your other mark from? You write 2 things about the impact on the audit report. And we've managed to do that both times. Second point to notice. There are 8 possible outcomes for an audit report. The 4 modifications, except for, adverse disclaimer. 3 potential additional paragraphs, other matter, emphasis of matter, merg, and the 8th outcome, which is none of the above. You'd think the examiner would spread it around a bit, and yet in this question, 2 stories and they're both except for qualified. Bit boring, isn't it? But it does go to show that if you do have to guess the audit report outcome, except for qualified is probably your best guess, because 9 times out of 10 it seems to be the answer, in the exam questions at least. Wunderbar. Wonderful. Another question successfully dealt with. Now you might notice that as we go through the course, I from time to time lean over here, pick up a pen, and I'm writing something down. What am I doing? I'm just keeping track of what we've done and what we haven't. And that leads nicely into the next bit of technical revision on this final evening of ours. Because I'd like to look at something called overall final review. What's this then? Well, what this is potentially a little bit odd. The whole audit process is governed by auditing standards that tell us what to do. But if you look up overall final review, you won't find an audit standard on this specific subject. Back in the days when Britain had its own audit standards, there was an audit standard on overall final review. But then we adopted international audit standards about 13 years ago. And the international standards don't have a separate standard with that title. But it doesn't change the fact that there are things you do right at the end of the audit before you sign the audit report. It doesn't change the fact that this is what everybody calls it. It's just it's not found in any specific standard. It's sort of spread around a bit. So because this is quite a difficult one to look up anywhere, I think it's worth us just reviewing it just for safety. So just to repeat, what is it? It's the final few tasks done right at the end of the audit, just before signing the audit report. So what do we do then? Well, we are getting near to the end of this course. I want to make sure I've done everything I want to do. So next to me here, I have my little plan. Auditors also want to make sure they've done everything they should have done. So one thing to do at the end of the audit is to fill out some checklists. For example, I would want to check that we did everything in the audit plan we put together at the beginning. So let's go and tick it off and make sure we did all the tasks, all the tests that we thought we needed to do. I also want to make sure that I have not forgotten any of the company law issues or the accounting standard issues that I maybe should have considered. So I'm likely to fill in a company law and an accounting standards checklist to ensure I've considered all possible relevant things. So I make sure I've done everything I think I should have done. A second thing I'd like to do at the end of the audit is take a look at the mistakes that I've found. Now, some of those mistakes should already have been corrected by the finance director, but I've probably got a list of mistakes that the finance director has said they don't want to correct and mistakes that I haven't told them about yet because they're relatively small. I need to add up all the remaining uncorrected misstatements. Now, a lot of those will be immaterial on their own, but if you add them all up, you can see if their overall impact is material. You can then go to the client and show them this list. And ask client if they plan to correct them. And if the client is not planning to correct them and they are material, I will need to consider the impact on my audit report. A couple of other things I ought to do right at the end. Because right at the end of the audit, I now know as much as I'm going to know about this client and understand them about as well as I'm likely to, because of all the information and understanding I've picked up during the audit process. And I would hope that I understand the client better than at the start. And that means there's a couple of things I should take one final look at. I should assess if the accounting policies that the client is using are appropriate to their circumstances. I'm bound to have looked at this at the start of the audit and probably during the audit, but now I know as much as I do about the client, I should take one final look. And the other thing I ought to do is I need to compare the final financial statements versus my final level of auditor knowledge or expectation. I will have done the same thing at the start of the audit. We did it there to assess the numbers that look like they might be wrong, so we could test them. Now I should know this client well enough that I can stare at the numbers, maybe calculate a few ratios, and ask myself, do those numbers make sense given my entire aggregated knowledge about this client? Assuming everything I've just gone through is fine, it is time to accept that this audit is done and sign the audit report. So that is overall final review. Not tested very often, and because it's not tested very often, if it comes up, it tends to be done very badly. We still have one other question that I'm going to be doing tonight. In our third class, I reviewed most of the internal audit part of the course. What I've not looked at yet on revision is this topic: corporate governance. Now this is a bit of an irritating topic for F8, I will be honest. If you were doing the P1 paper, this is about 35% of the course. It's a big chunk, so you need to know it pretty well. Understand it, but you'll get rewarded because there'll be plenty of marks on the exam. The difficulty for F8 is you do need to know, it seems, a lot of the detail in corporate governance, but it never seems to reward you for more than a small handful of marks. So you end up putting a lot of effort in for a fairly small reward, and there have been some papers where it doesn't come up at all. I think my advice therefore at this stage, with less than 7 days left, has to be that since this is not one of the big core mark getting areas, you need to know what corporate governance is. There is one topic in particular you'd be stupid to ignore, but with the rest of it, try to know it reasonably well. But if at the moment you've got no clue, there's no point trying that hard, because the amount of effort you'd have to put in for the reward you're going to get, it's just not worth it. So what type of exam questions might we get? Corporate governance covers a number of areas involved in running companies properly. One of those areas has the word audit in it, and since this is an audit course, the roles and benefits of audit committees is something we should not ignore. It's never going to earn you a huge number of marks, but it does come up, so we'll be taking a look at that. And the other way corporate governance tends to come up is a scenario question, and we have got to criticise a company's corporate governance. And the difficulty with that is she could pick virtually anything from corporate governance and throw it in to the story. So unless you know all of it, it's hard to spot those things which are wrong. This doesn't come up quite so often, so we'll revise audit committees first, and then we will have an overview of what sort of areas governance covers, and then we can look at a question. Audit committees. What do they do then? Well, what they do is they oversee internal control systems, risk management, and financial reporting at listed companies. Oh, do they know? Do they now? How do they do that? Well, this committee will typically have 3 members who are independent NEDs, because whenever you want something to be overseen, monitored, we'd want it to be done by independent people, so independent non-executives. And since this is quite technical, it will involve financial reporting, auditing, controls and stuff like that. At least one of these people should have recent accounting audit experience. So that is what they are going to do. Thing is, they are overseeing it at a relatively high level. These 2 things here are being tested in rather more detail by the internal auditors, and the financial reporting, of course, is being tested in detail by the external auditors. So if my job is to oversee things, and I already know they're being tested in detail by others, I am going to have to work quite closely with who those others are so I know what they are discovering. Therefore, the audit committee is going to need 2. Well, let's have a look at external audit first. it's going to have to monitor the quality and independence of the external audit firm. It is going to agree their audit plan, strategy, etc. before the audit takes place. It's going to agree the audit fees. It's going to recommend an external audit firm to the shareholders. And it's going to discuss with the auditors all the big issues that arose during the external audit process. And it is going to receive and review the audit report at the end, before the shareholders get to see it. And what, pray tell, will the Audit Committee do relating to internal audit? They are going to monitor the quality and independence of the internal audit function. And that is likely to include looking at that independence issue, e.g., deciding should it be outsourced. More on that later. Now, the external auditors, it's about agreeing the fees with the audit firm. The audit firm will decide what resources are needed to audit your accounts. With internal audit, you control them, so the Audit Committee must agree the resources that the internal audit function is going to need. It will agree the scope of the internal audit work to be done. So you'd expect the head of internal audit to say, this is what I think we ought to do. That will be agreed with the Audit Committee. And it will receive internal audit reports. So broadly, pretty similar stuff for both external and internal auditors. What are the benefits of all of this? Well, hopefully internal audit and external audit end up as better quality and more independent. And those two things mean increased assurance that internal controls, risk management and financial reporting are working well. So that's audit committees. Let's now have a reminder of corporate governance in a broader sense. And then we can take a look at our question. Corporate governance on this course is based around the UK Code. And the UK Corporate Governance Code, well, we could say it divides into 5, but for the purposes of F8, I think we can deal with 4. If you want a company to be governed, i.e. managed well, the starting point is surely to look at the people who are running it, the directors. So we need to look at the directors, structure of an effective board, and the use of board committees. And there's quite a bit of detail in that bit. The second area is a little bit less detailed, well, a lot less detailed, and that is directors' pay. The third area is the one of most relevance to auditing, because if you want a well-run company, you need effective controls, risk management, and corporate reporting. And if you want the company to be run in the best interest of the shareholders, two things. You need to listen to what your shareholders have to say to you, so communication, and you need to tell the shareholders what you've been doing so they can hold you to account. Communication. So a fourth area is the board's communication with the owners of the company, the shareholders. And if she's going to give you a story where you've got to criticise what's going on at the company, she could pick anything from any of those four areas. Let's start with one of the smaller ones, the board's communication with shareholders. This is primarily about having an annual general meeting with them, but also having extraordinary general meetings whenever the company has a bit of a crisis on. You don't want to wait another year for the next general meeting. Let's look at directors' pay, another of the relatively small ones. It should not be excessive. No director should be setting their own pay, because that's just a recipe for disaster. And pay should be made up of numerous components, including some fixed salary plus a reasonable amount of performance-related pay. So bonuses, share options, things like that. The performance-related stuff is important because it helps to align the directors' interests, i.e. the performance of the company, with what the shareholders want. Now the red and the green stuff I wouldn't get too excited about, but you need to know at least a little bit. The other two are more important. There's not too much to know with the third one over here. The company should have a formal control system, and that system should be subject to an annual evaluation to make sure that it is working okay. There should be a formal risk management system. And whilst internal audit is not a requirement, companies should at least consider the need to have it. The one that's got the most annoying details in it is the one above me here. Directors, board committees. For example, let's look at the board of directors. The board should have a chairman who runs the board and a chief executive who runs the company, and they should not be the same person. For the chairman to oversee the board, we want them to be independent, at least on the day they're appointed. We also want the board to have at least half independent NEDs. Because if there's at least half the board are them, they're in a much better position to keep an eye on the potentially naughty executives. We'd like a bit of diversity on the board. You know, men and women. Not just all 56-year-old men, but some younger people as well. Maybe not just British people, but overseas. We'd like the right balance on the board of skills, experience. And if people are joining the board who've not worked much in this industry before, we would like induction and training. And how do we know that the board is operating well? We should have an annual board performance evaluation. And then we need some committees. And the UK Code of Corporate Governance says there should be at least 3. And the 3 that it wants are the Audit Committee, which we've already spoken about, the Remuneration Committee, which does directors' pay, in particular the executives, and we need a Nomination Committee, who are the ones who take a look at who we've got on the board at the moment and decide maybe which ones need replacing, if they're getting a bit old, the current directors, a succession plan, so we've got someone lined up to take over in the future, and things like that. And because all 3 of these functions are very sensitive and very important, we'd expect those committees to be made up almost entirely of independent NEDs. How is a non-executive independent? I don't know. How is an auditor independent? An auditor is independent by not having financial ties to the company. Auditors get paid a fee for the number of hours that the audit takes. No profit-related pay and shares. If auditors stay with the client for too long, they get familiar. Same with non-executives. We don't want non-executives to be on the board too long, or they lose their ability to monitor independently. Now, for the number of marks that come up, it does not warrant spending any more time than that revising it, apart from having a look at a question so you can see what it looks like. Which is what we are going to do now. We will look at June 2014 and question number 4. A question I like because it gets us some internal audit practice and some corporate governance practice all at the same time, and that seems remarkably efficient to me. So there we have the June 14 paper. Question number 4. There we go. Get rid of the story, always focus on the requirements first. Part A. For 10 marks, explain the advantages and disadvantages for each of saxophone and cello of outsourcing the internal audit department. And I see here there are 8 marks for the pros and cons for saxophone, which is the client, and 2 marks for cello and co. Who are cello and co? Well, we'll go up here and I'll tell you. Saxophone has been trading for 15 years selling insurance, recently become a listed company. In accordance with corporate governance principles, Saxophone maintains a small internal audit department. The directors feel that the team needs to increase in size and specialist skills are required, but they are unsure whether to recruit more internal auditors or outsource the whole function to their external auditors, Cello and Co. So what are the pros and cons to Saxophone of outsourcing their internal audit and outsourcing it to their external auditors? And what are the pros and cons to the external auditors of doing the internal audit work as well as the external? Let's see if we can plan an answer. Pluses, minuses. Saxophone, the company, cello, the external auditor. We need to get about 8 things in the pluses and minuses over there. We only need a couple down here. Most of the pros and cons of outsourcing internal audit for a company are the same pros and cons with outsourcing anything. If you buy your own ingredients, cook your own meals, it's likely to be cheaper than if you get restaurants to supply your food cooked for you, because you're paying for specialists to supply their specialist skills. So one potential downside is probably it's going to be more expensive than doing internal audit yourself, because you're paying for experts, and experts are not normally very cheap. On the other hand, you could argue it the other way around and say, should I buy my own car and drive it myself, or should I outsource my driving needs to taxis? Well, if you need to take taxis on a daily basis, it's probably cheaper to have your own car. If you only need to be moved around once a month, one cab fare is probably cheaper, multiplied by 12 months, than it is than the expense of running and maintaining a car. So it does depend. You could argue it either way. On the other hand, once you've paid the money, a benefit is the experience and expertise of the outsourced company. And if you do pay for a taxi, you get to sit in the back, read the paper, make phone calls, and you don't have to worry about driving. So outsourcing allows the company to focus on other things, such as running the company. If you drive yourself around, anything you say, maybe a phone call in the car, stays in the car. If you have phone calls, conversations in a taxi, the taxi driver can overhear them. So one potential danger of outsourcing is a potential breach of confidentiality. Because an external provider is learning your company's secrets. Hopefully they won't tell anybody, but they might do. And you know another problem with taking taxis? The driver will drive the way they want to drive and the route they want to take. And that might not fit with what you want to do. When you have outsiders do something for you, they might lack company knowledge and the company culture, whereas your own employees will know the way you like things to be done. And you know another problem with taxis? There's never one around when you need them. If you've got your own car, you can drive whenever you like. The problem with experts is you might have to wait for the experts to be available. I've got 4 negatives. Positives, could do with a couple more in there. I suppose the big positive of outsourcing internal audit is it increases the independence of the internal audit function, because outsiders are now giving you opinions. Now, everything I've said so far is true of outsourcing internal audit in a general sense, But in this question, it's being outsourced to the external auditors. Is that a benefit to the company? Well, yeah, it probably is. Because the external auditors already know stuff about the company, it should mean the internal audit work is cheaper than it otherwise would be because they've already got the understanding of the company. In fact, if they end up doing the internal and the external audit work, maybe the external audit fee reduces because of the knowledge picked up during the internal audit work. There could be a bit of economies of scale here, or synergies. Well, I seem to have 8 separate points, so I really ought to have a crack at the bit down here. What is the advantage to Cello of doing external and internal audit for the same client? Well, don't be afraid of saying it. Cello get increased fee income, never a bad thing. But also, the internal audit work will help provide understanding of the client, which may mean a better quality external audit because you've got better client understanding. But there is one rather large downside with the external auditors doing the internal audit work as well. It's going to reduce the independence of the external audit. Why is that? Well, you end up with a self-review threat because the external auditors will audit internal controls, which the internal auditors, the same firm, may well have made recommendations on. The increase in fees may lead to a self-interest threat. The fact that you're doing more work for the client could lead to a familiarity threat, etc., etc., etc. So there's a bit of internal audit, the pros and cons of outsourcing, and it's sort of getting a bit due for that to come up again, which is one of the reasons I wanted us to look at it. But what about the second bit of the question? In respect of the corporate governance of Saxophone, identify and explain 5 weaknesses and provide a recommendation to address each weakness. This looks suspiciously like internal control weaknesses or deficiencies and recommendations. So what tips did I give you when doing that type of question that might also work here? I said, when you explain a control deficiency, try to talk about the damage that can be caused. When I said recommendations, I said don't just copy the deficiency backwards. They don't do X. Recommendation, do X. I said try to add some detail. I would imagine similar things will work in this story. I'd imagine there are more than 5 deficiencies in there, so if your corporate governance knowledge has a few holes in it, there's probably still enough for you to get your teeth into. So let us go look at the story and see what we can find. We've already read the first paragraph, and that appears to be entirely related to part A of the question. So let's keep on reading. Saxophone is required to comply with corporate governance principles in order to maintain its listed status. Hence, the finance director has undertaken a review of whether or not the company complies. So this lot is going to be the corporate governance story, and we need to find 5 things we don't like. Bill Bassoon is the chairman of Saxophone. Until last year, he was the chief executive. There's the first. I'll explain it at the end. Bill is unsure if Saxophone needs more non-executive directors, as there are currently 3 out of the 8 board members. And that will be point number 2. He is considering appointing one of his close friends, who is a retired chief executive of a manufacturing company, as a non-executive. That is number 3. And that is number 4. Going well. The finance director, Jesse Obo, decides on the amount of remuneration each director is paid. And that's number 5. Currently, all remuneration is in the form of an annual bonus based on profits. Number 6. Jessie is considering setting up an audit committee, but has not undertaken this task yet as she's very busy. They don't have an audit committee. Number 7. A new sales director was appointed 9 months ago. He has yet to undertake his board training. Number 8. As this is normally provided by the chief executive and this role is currently vacant, they don't have a chief executive. Number 9. There are a large number of shareholders. The directors believe it is impractical and too costly to hold an annual general meeting. They have no AGM, and that's number 10. Instead, the board has suggested sending out the financial statements and any voting resolutions by email, and then the shareholders can vote by email. We need 5, and I think there are 10. To me, the best thing to do, therefore, is go pick the 5 that you are happiest explaining and that you can come up with a recommendation for that's not just repeating the weakness. You can add something to it. For example, let's look at number 2. 3 of the 8 board members are non-executives. Well, you need to know, of course, one of the things I just went through. At least half the board should be independent non-executives. Why? To ensure there are enough of them to be able to monitor, keep an eye on the executives. At the moment they have 3 out of 8, and 3 out of 8 is 37.5%. which is not enough. What do you recommend? Well, one way to get to 50% is sack 2 executives. But if you've got people on the board running the company, I'm guessing they're there for a reason. The best approach is to hire 1 more non-executive. That gets you then 4 out of 9. That's still not 50%. Hire 1 more, 5 out of 10. There you go. Recommendation. 2 independent NEDs need to be recruited ASAP, and if you want them to be independent, get them from outside the company. That would get the quota up to 5 out of 10, which is 50%. Job done. What else have we discovered? Currently, there is no audit committee. Why is this a deficiency? Talk about the potential damage, if at all possible. So, controls, oh dear, risk management and financial reporting are not being independently overseen at the company. Also, internal audit and external audit have no one independent to report to. Which means their effectiveness is going to be hampered. It's very easy in a question like this to just say there's no audit committee. There's no this. They don't do that. They don't do that. Say it, say why. Say it, say why. Recommendation. Add. Who, how often, when, where, anything. Well, in the question, it said that Jessie, the finance director, should be setting up the audit committee. Well, she's an executive. I don't think she should be setting this up. I think the chairman of the board is the person in overall charge of making sure that the board and its committees comply with corporate governance. So I think that the chairman should organise an audit committee, add some value, with terms of reference to oversee internal controls, risk management, financial reporting, and liaise with internal and external audit as appropriate. I might also say that the audit committee should comprise 3 independent NEDs, of whom at least one should have recent accounting and audit experience. In fact, that's so good I'm going to write it down. Committee should have, oh dear, this pen is being naughty, 3 independent NEDs, of whom at least one recent accounting and audit experience. Now, whilst this is a practical question, because you've got to go through a story, find the deficiencies, explain why they're deficiency and make a recommendation, it's actually quite a knowledgey type question, because most of what I'm writing is just knowledge applied to the story. So it's not really that difficult if you've got the knowledge. Well, that's 2. Let's do a third one. A third problem I had is the finance director decides on the pay of directors. Why don't I like that? Well, this means the FD decides their own pay, the pay of the other executives, who may well be friends and are certainly colleagues. And that means the finance director has a very clear incentive and ability to overpay herself. I think it was a woman, wasn't it? Herself and her friends. What do we recommend? What we recommend is there needs to be a remuneration committee of independent NEDs is needed. Not enough words. Add something. It should set policies, re-directors' pay, and propose individual packages for each director. And that is number 3. What else do I not like? The chairman is wanting to appoint one of his close friends, point number 3, who is a retired chief executive of a manufacturing company as a non-executive. Number 3, chairman appointing own friends. If the chairman is appointing someone who is their friend, there is a danger that that person is being appointed purely due to the friendship and not for the skills and experience the board actually needs. Now, I think it's probably a separate point, but I've got so many points, combining a couple doesn't seem like a bad idea. It's not like I'm going to run out of things to say. And experience in manufacturing might be of little use in an insurance company. But the underlying problem is this person is being picked because they're the friend, I would imagine. So what do I recommend? I recommend the chairman should not be choosing new directors. Instead, you should have a nomination committee. And to help them find suitable people, they should assess the needs and skills of the board that are required, and then use executive search companies to help recruit the people that you need. So there's number 3. Now, I'm not going to write any more of these down, but let's talk through the others. The very first one, number 1, is probably one of the less obvious ones. But if the chairman used to be the chief executive, when the chairman is overseeing the board, they're overseeing the executives that used to be their colleague when they were the chief executive, which means you are having a bit of a familiarity threat, to be frank. We do not want chief executives to become chairman. The chairman is largely a monitoring role. They need to be independent. Recommendation: the company needs to find an independent chairman as soon as possible, preferably from outside, but if one of the existing non-executives is independent, they should take over as chairman, even if it's just in an interim role until you get someone longer term in. And by the way, there's no chief executive at the moment, and since Bill Bassoon used to be the chief executive, why doesn't Bill go back to being chief executive until you can find a new one? We've done number 2, done number 3, done number 4. Number 5, we've done as well. Number 6, all remuneration is in the form of an annual bonus based on profits, which means there is no salary for directors. They only get paid if the company's profitable. Well, I've got two problems with that. Problem number one is if the executives know there's no hope of making a profit this year, they're not going to get paid. So what's their incentive to try anymore? It's like a football team that already knows it's relegated. They'll give up. Second problem. This seems to be all directors. That means the non-executives are getting profit-related pay, and that means they won't be independent. They should just be paid a fee, like auditors are just paid a fee. So the non-executives should be paid a fee based on the number of days they commit to the company. The executives should get some fixed pay, salary, and also some performance-related stuff to incentivize them. Number 7, there's no audit committee. We dealt with that one already. Number 8, new sales director has yet to undertake his board training. That may mean he has a lack of understanding of the company, the laws and regulations of the insurance industry. If he's not been a director before, he might not understand in full his legal duties as a director. Recommendation. His training needs to be organised ASAP, and the chairman is in charge of making sure these things should happen, so the chairman should organise it. Number 10, no AGMs, too expensive. Rubbish. They should have an AGM. They should invite all the shareholders. They can certainly allow shareholders who can't attend to vote by email. Nothing wrong with that. In fact, it makes a lot of sense. But telling everyone they're not allowed to attend, there won't be an AGM, is too much. So they should have it. They should give plenty of notice about it. They should hold it in a convenient location at a convenient time so that as many shareholders as possible can attend. There you go. A massive, comprehensive, thorough corporate governance grounding. I almost hope now it comes up to make everything we've just done have some value. A bit more technical revision required. For example, something I've never got that excited about on revision, because if you know it, because it's fact. But it's been a while since this has come up, I suppose, and quite a few people have asked me about it recently, so why not? We're talking here about the planning phase. The audit plan is probably the easy bit, because the audit plan is the detailed list of tests we expect to do, which members of staff will do them, the dates when all of this work is going to take place, who will review the work, and because we know a specific plan of what we're going to do and who's going to do it, a budget for the cost of the audit. But you can't get down to that level of detail without starting at a higher level first. And that's basically what the audit strategy is. And if you think about it, planning anything tends to start in a sort of generic way and then gradually gets down to the detail. When I'm timetabling, I start off by thinking, well, what programs do we want to run? ACCA, okay. How many papers does ACCA have? 16. Okay, when are the exams? What sort of people do I need to teach these courses? What materials will I need to teach these courses? What classrooms, what studios will we need to teach these courses? And then gradually we get down to working out how long the courses are likely to be, roughly when do we want to do them, who have we got available to do them, and then we basically at the end get to specific classes on specific dates in specific locations covering specific material taught by specific staff. How does this work for an audit then? If you ever look up audit strategy in a textbook, it will throw 3 words at you. The audit strategy is about the scope of the audit, the timing of the audit, and given the scope and the timing, how to direct this work. What do we mean by scope? By scope we mean the quantity of work we expect to do on the audit, the type of work we expect to do, and who will do it. The timing is when will we do the interim, when will we do the final audit, when will we have the various client meetings, when will the client have their records ready. Actually, let's take that bit out. We'll come back to that. Doesn't really make sense the way I've just done that. Direction. Briefing staff at the start of the process. A debrief, completion meeting, at the end of the process, and review of files, including perhaps by a second independent partner if this client is listed on the stock exchange, high profile, high audit risk, ethical threats, etc. So those are the things we need to decide. Question is, how do we decide these things? What factors will influence? Well, the scope of the work we're going to do is going to be affected by things like the nature of the entity, what it does, because that is going to affect the inherent risks of misstatement. The nature of their controls will affect control risk. The amount of IT they use will affect the type of IT the auditors will want to use. The nature of the entity might also have an impact on the need for experts on the audit team. It might also impact on whether to rely on the client's internal auditors during this audit. Timing of the audit will be impacted by things like what locations the client is based at, client deadlines, and the point I started making and then realised it's better down here, the availability of client records, because we can't do the audit until they can supply the evidence. I suppose also the quantity of work we do is going to be heavily impacted by a materiality assessment. Although whether I can fit this in or not, there we go, look, just about squeeze it around the outside. So when you're looking at an audit strategy document, those are the sort of things in black that you would expect to see in the document, because those black things then lead to the end of the strategy, which is the blue stuff at the top of the screen. Fascinating stuff, isn't it? Okay, so we've done that, we've done that. Another audit standard to remind us of. Audit Standard 240 shows the auditor's duty or responsibilities relating to fraud at a client. What are the auditor's duties? Well, the primary audit duty is, of course, to give an opinion on the truth and fairness of the financial statements. In what way does fraud relate to that? Well, if fraud exists at the client, it is likely the financial statements contain material misstatements. Why is this? Because if fraud is taking place, there is a possibility that assets that the company thinks it has have gone missing, or any accounting entry could have been manipulated to make it look like one thing when in fact something else is going on. So fairly clearly, if fraud exists, the accounts may not be true and fair. Therefore, what is the auditor's duty regarding fraud at clients? Well, it's the same as any risk of material misstatement. We need to understand the client well enough to assess the risks of fraud taking place. And as with all other risks, we then design responses to those risks. In other words, we design tests to see if the fraud is happening. If we find a fraud, we need to consider its impact on the financial statements and therefore potentially on the audit report. But if we find fraud, we must also tell people. Who are you going to tell? Ghostbusters? No. You tell management. because they might not realise that members of staff are committing fraud. Unfortunately, the vast majority of fraud, it seems, is carried out by management in companies, so telling them might not really achieve much. Whenever anything interesting happens on an audit, you tell the Audit Committee, otherwise known as the beautiful TCWG, those charged with governance. And if there is fraud going on, you might have to consider reporting it to an external regulator of some sort. But that would be a breach of client confidentiality, so I suggest you take legal advice before you do it. And if I'm auditing a company and there's a lot of fraud going on, and if I think management are involved, oops, didn't mean to do that, apologies. I'm not convinced I would want to be auditing this company anymore, and I think we should strongly be considering resignation on the basis that the integrity of our client is in question. And there we have it, another audit standard successfully reviewed. Okay, we have got about 10 minutes left, and that is it. We have covered questions on all the core areas. We have covered some questions on the non-core areas. I'm trying to fill in with a few bits of detail and knowledge and understanding just to top you up as much as possible. But it's time we started bringing this down to a review of the key things you need to do between now and next Monday when this exam takes place. Obviously, some knowledge is required to pass the exam, obviously. True for any exam. But roughly 2/3 of the marks on this exam don't really need much knowledge. They need practice. Practice coming up with points and practice thinking how you would explain those points with enough specific detail. For as many questions as possible from the last 4 to 5 years, read the requirements only, not the stories. Plan your tactics. I'll say more about that in a second. And once you've planned your tactics, go and read the answer. Now, that might sound like cutting corners, because you're not going to write an answer. But this is such a tactics-based exam. This is a very powerful way of giving you some assurance that you're on the right track. I'll give you an example. Risk and response. What have I told you to do? I have said when you do the risks, try to say which figures in the accounts are at risk, over or understated. Explain why. So if you go to do a past exam question and it says describe the risks of describe the audit risks and the responses, what you're hoping to see when you read the answer for the risks is at risk of being over or understated, and then an explanation of why. And if that's what you see when you get to the answer, and that's what you were hoping to see, it reinforces that that's the technique to use. Responses can be a number of things. They can be audit tests. They can be deciding which staff you put on the audit. If controls are weak, the response is more substantive testing. If you're worried the directors will manipulate the figures, increased professional skepticism. And if you've read the question and thought those are the sort of things I'm looking for, and then go read the answer and those are the sort of things you see, that will reinforce the technique. Now that's good, because it tells you you know what you need to be able to do. For a rather smaller number of questions, because this will take longer, you do the same as the above, but then you read the story and then you write your own answer points in full to practice how to explain this stuff. Doing that gets you practice in writing, but it also gets you the very essential technique practice. And with technique, it's all about repetition to get yourself into the habit of doing it. That's one thing you should do. But this is very focused on the long questions. Now, there's 70 of the 100 marks, so that makes sense. But we've also got MCQs. And for various reasons, you've ended up with a massive pool of MCQs you can practice. You have got the December 2016 computer-based exam on Acca Global. You can't print it out, you can't download it, but you can go through the computer-based experience, and I would go and do those MCQs. They're a nice recent pool, therefore recent style, and they get you a good test of 15 bits and pieces on the syllabus. You've also got the September 2016 MCQs in full, because they published that paper. You don't have any MCQs from March or June 2016, or from September or December 2015. You have, however, got June 2015 and December 2014, but these are old style MCQs. In fact, it's just dawned on me you've got another set of new style MCQs, because when they changed the style, they brought out a specimen paper. So you've got 15 questions there, 15 questions there, 15 questions there, 45. If you've not already done it, there's the revision mock, where I have very kindly written another 15 for you. So there's 60. All current style. Now personally, I think that's pretty enough, but if you want to do some more, the old style ones, you only got 12, but there's another 24. There's 100 new style in the revision kit, 127 old style in the revision kit, and by now there's way too many. Focus on the new style ones first, practice as many as you can, repeatedly, to get you into the habit of thinking through the answers, because a lot of the more recent style ones are not that based on knowledge. They actually require a bit of thought. They also have calculations in some of them, so take a calculator on exam day. Now that's all great, isn't it? That's what you need to practice. On exam morning, The only things that you need to be thinking about are tactics. Don't think knowledge. It's too late for knowledge and it's not a real knowledge paper. You need to revise your tactics. Those tactics are general tactics for this paper and they are specific question types. You know by now the general tactics. Explain every point you make. You've seen me do it. Every audit test to verify everything I write because da 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 da. Be specific in your suggestions. Check it's right. How? Agree to documentation. Which documentation? Get a discussion with the directors. About what? Read the board minutes. Why? What you're looking for. Be specific. And then there are three main question types that come up over and over again for lots of marks. There is risk and response. There's internal controls. And there is substantive procedures. And it feels like I've told you all this stuff way too many times already. But since it is the final class, a little reminder. Risk and response. For most audit risks, it's going to be which area of the financial statements is at risk, over or under, and why. For internal controls, key bit there, make sure you know the difference between a control objective versus a procedure versus a test. Objective, to ensure something good happens or something bad doesn't happen. Procedure is what the company does to achieve that. Test is what the auditor does to see if the procedure is happening at the company. Most common exam question, control deficiencies, control recommendations. Recommendations, add. Who should do it? When should it be done? How often should it be done? Deficiencies, talk about the damage to the company as a result of that deficiency. Substantive procedures, make sure you're thinking through assertions. AEIOU, DADA 3 for ideas. And if there is a scenario, a little story, test every fact that is in there. That is basically all you need to be thinking about on the morning of the exam. And then the exam starts. I strongly recommend ignore the MCQs for now. Go straight to the three long questions. Read the requirements and write your tactics next to each of the practical questions that are there. Why are you doing this? You're doing it because at the start of the exam, the tactics are still fresh in your head, and also, at the moment, you're not panicking. If you write the tactics down next to the requirements, when you actually answer the questions, which could be 2 hours away for some of them, and you're panicking and you're stressed, the tactics are there. It's like having you from 2 hours ago tapping you on the shoulder saying, relax, don't forget to do it like that. I'd do the MCQs last if I was sitting this exam. I really would. Loads of reasons why. The main one, I suppose, being that if you run out of time, you can always guess the letter, can't you? You can't guess the long questions. Okay, enough. Enough. You know what you need to do. You know what you need to practice. You know what you need to be good at. You'll know if your knowledge has felt a bit rough during this revision course and you've got some knowledge to pile in there. But please never forget, F8 is 2/3 what you can do and 1/3 what you know. And your exam preparation has got to be similar to that. You've got to practice the long questions. Well, it is Monday. In 1 week's time, the exam happens, and that means that on Friday of this week, from 6 till 7 p.m, we will have the final 1 hour mentoring session. I will remind you of all the key tactics, methods, techniques you need to use, but also I will be there to answer any questions you might have. 6 till 7, Friday night. Think about it during the week. Make a list of all the questions you want to ask. If you can ask them before that, even better. And I warn you now, quite a few people tend to turn up to that who've not asked a single question all term, and it can get very busy. I'll see you on Friday. For now, good evening.